Well, with Donald Trump's return to the White House, our next guest says to expect a lot of flux in not only the stock market, but the economy as well. Let's bring in Martin Cobb, Senior Vice President of Equities at Lorne Steinberg Wealth Management. He joins us remotely, as you can see. Martin, thanks a lot for joining us. What are you telling your clients about these North American stock markets? We're only a couple of weeks into the trading year, and already the S&P 500 has a gain going of almost 3%, quote-unquote, year to date.
Yes, there's a lot of debate out there on where we are with stock markets after 2 years, particularly the S&P 500 being up over 20%. I hear a lot of chatter, are we in a bubble? Are we not in a bubble? I don't think that's a terribly helpful way to think about it. I'm not one for lauding investment gurus, but there's one individual who I read more often than not, and that's Howard Marks of Oaktree. He's coined the idea of a pendulum that swings from optimism to pessimism. And in his most recent memo, he would suggest, reading between the lines, that we're closer to the optimistic end of things than the pessimistic end of things. Indeed, he highlights the JP Morgan study, which shows that current valuation levels, long-term returns from here are decidedly lackluster.
That the pendulum swinging to the optimistic side suggests amply priced markets and perhaps retail investors who are overly optimistic, as they tend to be at market peaks. Is that a fair summary of your reading?
That's a good summary. I mean, he's talking more about investor sentiment, but it's the same thing. That works its way through into market valuations. Talking more about south of the border in terms of the US market, more than perhaps up here in Canada. But it feels that people are pretty optimistic, and there's lots of studies that show that economic growth and S&P 500 or Canadian TSX performance are not linked at the hip in the short term. So whilst people might be expecting, and I'm not necessarily saying we're going to have a bad economic environment, that doesn't necessarily mean that we'll have a very good stock market environment.
Okay, so with that in the background, what type of equity market exposure are you advising your clients to have at Lorne Steinberg Wealth Management? In fact, what kind of equity market exposure are you putting in place for them, recognizing that each client is different?
Yeah, we're very well diversified. Indeed, it's the one thing that maybe keeps me up late at night more than anything else. Are we properly enough diversified? I like to think of a golf analogy, if you don't mind me using golf. I'm a keen golfer. Not necessarily a good golfer, but a keen golfer nevertheless. And there was a study done in 2003 comparing John Ram and Scottie Scheffler. Now, John Ram and Scottie Scheffler had almost identical averages over the course of the season. But John Ram did it by getting a lot more birdies. He's a much more aggressive type of player. Scottie Scheffler, on the other hand, gets there by getting a lot less bogeys. He's a much more conservative type of player. So sitting here today in 2025, maintaining diversification, absolutely. I think it's time to be more like Scottie Scheffler than it is John Ram.
Okay, you've got some stocks that you like. Adobe is one of them. Why so?
Adobe. What does Adobe do? Well, creative sorts like my wife, my daughter use their Photoshop suite of Illustrator products, etc. I use their Acrobat Office products. In fact, they've got a lot more to it than that. They're not just a one-trick pony. They have a lot of CRM, data analytics products. Now, Adobe was probably one of the worst performing software stocks last year, in a year where technology stocks did extremely well. Now, why was that? The threat coming from AI. OpenAI have a product called DALL-E, which is an image generation tool, and it is going to be a competitive threat to Adobe. That being said, this is a company that has, and is still expected to, grow something like 10% revenues growth per year. In addition to that, it converts every $1 of sales into something like 40 cents of free cash flow. There's very few companies in the world can do that. Adobe today, because of the fears of competition, despite the growth rates that we anticipate, is trading on a discount to the market. This is a company that's historically traded on a 50% premium to the market. Yes, there will be competition. They will invest. They will have to invest to combat that and improve their product suite, which they've done in the past. But you're buying at a big discount of what it's historically traded on. To me, that's a good risk-reward position.
Okay, you also like a lesser-known company, certainly to North American investors, Compass Group, CPG, which trades in London, the world's largest contract catering business.
Yes, contract catering. Think your school canteens, think universities, think hospitals, defence facilities, sports stadia, oil rigs, etc. This company, about 2/3 of its sale in the US, operates in 40 countries around the world, serving food to people like you and me. It is still a largely in-house market. 50% of the market is still in-house. So the contract caterers like Compass, like a Sodexo, are taking market share from that. I've known the company for decades, but got very attracted to it during the pandemic because a lot of its customers disappeared. I think schools being shut, us not going to the office, etc. So we bought it very fortuitously, but after they bolstered the balance sheet at a time when a lot of its competition was going to the wall, it's reestablished its growth rates, makes very solid margins, it's got a very strong balance sheet. We view it as a long-term secular grower as long as the world continues to eat.
Okay, and let's bring it home to Canada, TC Energy. You've got exposure to one of Canada's pipeline giants on behalf of your clients.
Yes, it's one of Canada's pipeline giants, although most of its pipelines are actually in the US. We've owned TC Energy for 5 or 6 years, but we actually bought a very big position in late 2022, early 2023, when they had the cost overruns on their Coastal GasLink, which runs in British Columbia. What struck me about that is the cost overruns they were talking at the time were maybe 4, maybe 5 billion. The market cap felt multiples of that, so the stock was hit very hard. I like pipelines. Indeed, pipelines, they're very hard to build them, as we know. They're very costly to build them, as we know. So once they're in place, they're great assets, very dependable cash flows, 95% regulated or contracted with high-grade, counterparties. The stability of cash flows, allowing them to delever. I also like what they've done, spinning out the liquids business and selling some other assets. Positions them well to continue to grow the dividend and reward shareholders over the long term, trading at a discount to what we believe it to be worth.